السلام عليكم ورحمة الله وبركاته. حياكم الله معنا جميعا في أحد ندوات الأكاديمية المالية. Welcome to the Financial Academy webinar. This is Ibrahim Al-Khifam. Speaking about the Financial Academy, the Financial Academy is one of the initiatives that support the vision of the Kingdom of Saudi Arabia in 2030, and to close the gap of and to improve your knowledge and skills in the financial field. Today we have one of the webinars that will, inshallah, guide you through the financial sector and financial field. We have Miss Winnie. Miss Winnie has recently graduated from University of College London with MS in Sustainable Resources, Economy, Policy and Transaction. She joined CFA Institute in January 2023, and the focus of her research is on sustainability. Welcome, Ms. Winnie. Hi. I hope you have a wonderful journey with Ms. Winnie. Wish you all the best. Thank you.
Thank you.
Yeah.
Maybe I can start very briefly with my background. Indeed, I had been, before joining CFA Institute and studying at UCL, I spent most of my time as an equity analyst, primarily for China, and then I had worked for both buy and sell side and private equity. So I, before joining CFA Institute, I worked for BNP Paribas, HSBC, Deutsche Bank before, and also on the buy side, AllianceBernstein. So now I'm here based in London, working for CFA Institute as an affiliate researcher. And I'm indeed, thank you very much for FA and CFA today for giving me time to introduce my research project, which focus on transition finance. I hope everybody can see my screen now. And before I start my presentation, let me ask you one question. How likely do you think the investment industry's financing mission will get to net zero by 2050? You can keep the answer to yourself for the time being. Here is our agenda for today. So transition finance can be used to describe as financing decarbonization of high emitting activities or financing countries as they develop while tackling environmental and social challenges. For our project, we are referring to the decarbonization of high emitting industries, companies, and the development of enabling solutions for decarbonization of other industries so as to achieve net zero. So it is about the climate change mitigation, that is to reduce emission from high emitting industries like most commonly include steel, cement, chemicals, shipping, aviation, and usually it involves hard to abate emission, meaning it is technically and or financially difficult to reduce. You can see just cement and steel alone, these two sectors account for about 14% of the world's emissions, and the demand for steel and cement keeps growing. We just can't build our modern world without them. But the thing is, a lot of financial institutions, particularly sustainable funds, are still trying to avoid these sectors. I don't know what is your answer to the question I asked earlier, but it is indeed one of the questions we have in the member survey we did earlier. So our result at that time is 65 of respondents said it was unlikely or very unlikely that the investment industry's finance emission would get to net zero by 2050. I'm not sure about if we have a poll, then what will be the result today? But think about that. Indeed, we probably can. If the real economy does not move in line with our net zero pathway, the net zero asset managers can divest from all carbon intensive sectors to deliver portfolio net zero. So the real question is, do we want to decouple from the real economy to achieve portfolio net zero, or do we want to go hand in hand with the real world to achieve net zero? The objectives of our projects are calling for attention to the importance of a shift to finance emission reduction instead of reducing finance emission, and focusing on real-world impact instead of avoiding it. We want to dig deep into the challenges in practice by interviewing investment professionals in the sector, and then explore solutions to overcome those obstacles. Our methodology is by depth research, and as I mentioned, interview with investment professionals. So starting from April this year, we have conducted intensive interviews for qualitative input from over 20 investment professionals, most of whom we intentionally chosen from different actor groups in the transition finance system. This is a project in progress, so your feedback is very welcome at this stage. Let's learn about the current status of transition finance first. So it is estimated that up to 32 trillion US dollar investment for this decade is needed for net zero transition. And if you see like electricity, like renewable energy alone can't do the job. It's around 50% of the total investment, but indeed we still need over 14 trillion US dollar investment in decarbonization of high emitting sectors and another 52 trillion in 2031 to 2050. This includes like industry, agriculture, buildings, transport. And a breakdown, and based on a survey, only 40% of high emitting companies have joint plan to achieve net zero by 2050. A breakdown by sector you can see here on the screen. Out of those with net zero targets setting, only 30% said their budget will be adequate to support their decarbonization targets. And out of those who didn't set any target yet, 53% said the main obstacle is lack of reliable financing. So put simply, high-emitting companies need external finance to decarbonize. Are all high-emitting companies eligible for transition finance? Honestly, I don't have a strict answer because eligible transitional activities vary by country. It is defined most often by taxonomies, and different country will have different methodologies to screen transitional activities, and also they have different technical screening criteria. In Japan, there's no taxonomy, but they have drawn sectoral roadmap with technical criteria to define transitional activities in 9 high-emitting sectors. Apart from that, the sectors covered by different taxonomies and roadmaps are different. For instance, in Chongqing, municipal city in China, clean and efficient use of thermal coal is deemed as eligible activity. But in Huzhou, which is also a city in China, it is not there. To seek transition finance, we also need a credible transition plan. But there are quite a number of transition planning frameworks and guidelines. To name just a few, we have OECD here, CDP, Climate Action 100, we have ICMA, and the disclosure framework developed by the UK Transition Plan Task Force, which could potentially become the first mandatory disclosure framework, is also developed. Luckily, if comparing with like taxonomies we mentioned earlier, the many elements in these many different guidelines and frameworks, they are largely harmonized. Transition finance overlaps with like sustainable impact, climate, and like green finance partly as well. So implying that sustainable fund, impact fund, and or climate fund can potentially support transition finance depending on the fund's investment objectives and methodology. ICMA published principles and guidelines for debt instruments of sustainable impact, green bond, climate bond, and transition finance. Currently, transition finance is extended primarily through sustainability-linked bond and loans, which is often general corporate purpose instruments. There is also transition bond, most often use of proceeds bonds issued by high-emitting sectors. Out of all sustainable bonds issued, high-emitting sectors only accounted for 2.5% of total now. is a breakdown of outstanding sustainable debt securities, including bonds and loans. Loans here, bonds here. So we can see significantly more sustainability-linked loans than sustainability-linked bonds, whereas on the contrary, we have significantly more green bonds comparing to green loans. It demonstrates what the fixed income investors and funds prefer. Transition bond is included as sustainability bond here. And seeing the breakdown, the transition bond market is dominated by Japan and China in recent years. It is because the Japanese and Chinese government support and encourage development of transition bond market. They are mostly in local currency, and investors are also mostly from domestic markets. If foreign capital is needed, then high-emitting companies will go for, as we mentioned, sustainability-linked bonds and loans. It is also because, to recall previously, that sustainability-linked bond and loans are for general corporate purpose, making it a more flexible instrument than transition bond, which is mostly for use of proceeds. However, for investors who don't like structured product, they will prefer transition bond, which is plain vanilla bond mostly. In the equity market, high-emitting assets are often underweighted by ESG or sustainable funds. Sustainable equity funds are important for net zero transition because it helps accelerating the transition through engagement. In general, ESG funds as well as investors have a green bias that low emissions occupy our mind. But we want to point out that growing the green economy alone is insufficient to green the economy. So transition finance is the youngest in the sustainable finance family. It is, if not problematic, the misunderstood child. It can be confusing as there is no universal definition. Investors worry about transition washing. As a fund manager, if you support transition finance, your portfolios very likely will be of high finance emission, and at the end of the year, you need to explain, spend more time to explain what happened there. And transition of hard-to-abate sectors usually involves new technologies like carbon capture and also like green hydrogen. So the risk could be higher. How do we balance and justify the risk, return, and real-world impact? There are more challenges just by that research, as you can see here in the table. And most importantly, it requires a shift in mindset from risk and return alone to risk, return, and real-world impact. We call it triple R. So we started our project from April this year, and here we share part of our key takeaways from the interviews, from the interviewees. So when we talk about, let's say, real estate, it is always location, 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 meaning buy, buy, buy. But every time we talk about climate change, it is emission, emission, emissions. So, and we naturally try to avoid. And it could lead us much further apart from net zero. For portfolio decarbonization, most often, asset managers will divest high-emitting assets and increase weighting of low-emissions tech stocks. But that contributes nothing to real-world decarbonization. We have not seen any single commitment from net zero asset owners that they're going to allocate proportionate capital according to real-world decarbonization pathway. Current disclosure required target setting by corporate, but cannot tell you whether the target is feasible. We talk about a change of mindset is needed, and our interviewees remind us that it is not just institutional investors. Regulators, service providers like auditors also need to change with us. Meanwhile, regulators are still focusing on finance emissions a lot. There are a lot of complaints about SFDR not helping. It is just about reporting, but not defining. Regarding investor education, that for retail and high net worth clients, it is not very effective, as we have to go through many gatekeepers like relationship managers, investment advisors, and message get lost in translation. There's no universal definition of transition finance, and therefore no clear definition of transition finance products as well. Hopefully, UK's new labeling system will help to provide some clarity. From a bigger picture, we need something that shows us the money, making brown to green transition bankable. Willingness to report goes hands in hand with capability. So next time a corporate complains about data availability, data quality, you probably should read between the lines. What can we do? Let me summarize the problem first. We don't see enough commitment by institutional investors, by corporates, and by governments. Sustainable fund managers understand the importance of brown to green transition, but we don't see sufficient action. We don't see enough corporate transition plans that are credible, and we have no idea about their feasibility. We don't see enough economic incentives, and a lot of the policies and regulations are still work in progress. We are drawing recommendations to raise this misunderstood child. Please allow me to reiterate that our projects is still work in progress. So below, I listed the options we are considering. Firstly, we need to empower the storytelling of transition finance and brown to green transition. So corporate can convince investors and financiers of their transition being actionable instead of theoretical. And asset managers can convince retail investors of the impact of their transition finance strategy. It is money we talk about, so it is still about balancing risk and return. We believe we need de-risking solutions for private capital, particularly for the developing market. And repeatedly, we mentioned about transition washing risk that we also need to tackle. Thirdly, we need effective government interventions, including sufficient clarity and economic interventions to incentivize decarbonization. To make the storytelling more effective and persuasive, we need to bring real-world decarbonization under the spotlight. The first step is to require reporting of emissions together with decarbonization. This is just to remind investors that low emissions and lowering emissions are equally important. The most commonly used metric is weighted average carbon intensity, WACC. And most often in the fund fact sheet, you will find WACC versus benchmark. One easy move is to report also the change of WACC year on year. This is, as we mentioned, to put decarbonization and on the same page next to emission. In practice, Allianz rolled out a KPI-based approach for a sustainability-focused product from late 2022. The first KPI launch is reduction of WACC, exactly what we mentioned, with targets set as either a minimum of 5% WACC reduction year on year or lower than benchmark. Allianz has applied the changes to the investment objectives of their fund where applicable. And please be reminded that, however, it is just portfolio decarbonization, which is not necessarily real-world decarbonization. In recent years, for instance, because of high inflation and strong US dollar, WACC, which measures the carbon intensity per US dollar revenue, can be delusive. If we can adjust WACC by inflation and exchange rate, we will be one step closer to real-world decarbonization. To demonstrate, you see here, a 7.9% year-on-year decline of portfolio WACC based on a hypothetical portfolio versus a 12.4% decline if we adjust WACC with exchange rate. It looks great, but don't forget the very high inflation. So unfortunately, we can't adjust for inflation because each of the portfolio company in my hypothetical portfolio operates in multiple countries and we don't have enough information. So here we suggest corporate to report their inflation and exchange rate adjusted carbon intensity. So the asset managers can aggregate for their portfolio and report accordingly. So here we can see we need a dashboard of metrics indeed to reflect real-world decarbonization because each metric by itself cannot tell the full story. In our dashboard here, carbon intensity per output does not reflect, does not exist indeed for companies without commodity output, for instance, service industry. And for total emissions here, a decarbonization leader indeed gained market share and will likely see a rise in total emissions, although it decarbonized aggressively. The last step is attribution analysis. As mentioned, portfolio decarbonization can be attributable to divestment or allocation adjustment. In many asset owners' annual report, we can find attribution analysis and explanation for divestment or adjustment of allocation is also provided. In a consultation paper published in April by the Joint Committee of European Supervisory Authorities, the paper asked for feedback on their proposed amendment to SFDR. And such changes include more disclosure requirement for decarbonization targets, that in the fund documents, fund managers in future will have to clarify whether they are referring to portfolio or real world emissions, and whether the targets are achieved through divestment or positive screening. We believe our discussion of relevant metrics here will become relevant to the potential changes. In our report, we'll briefly discuss also avoid emissions for transition enabling activities and low carbon investment as a forward-looking indicator. Let's give our asset managers the benefit of doubt. Indeed, we also think that corporate transition plans are not convincing enough. We recommend corporate to provide economic feasibility of their transition plans. CSFD recommends corporate to disclose their decarbonization target and the associated plan and strategy. The target is known as science-based target. But what it means is, it is based on allocation of carbon budget under scenarios aligned to Paris Agreement for the respective sector, and has nothing to do with the corporate's business trajectory. It is more like an assignment for the corporate to work on, and the result is a transition plan. As high-emitting corporates need to count on technologies like carbon capture and green hydrogen, which is still under development. So the economic feasibility of their transition plan could be doubtful. If we know the corporate's transition plan, how the probability of achieving their targets, then we know how savable a company is. It will inform decision making. Because honestly, only a savable corporate work to be put under the radar screen and worth for investment managers' time and resources on engagement. We found this Canadian Pension Plan Investment CPPI's projected abatement capacity assessment, PAC assessment, helpful. The idea is similar to oil and gas reserve reporting requirements, under which undeveloped reserves are categorized as proven or probable, based on the likelihood of commercial recovery using reliable technologies available. CPPI's assessment is based on NPV, and emissions are deemed economic to abate if total revenues over the lifetime of investment exceed total capital and operating costs. And the results is presented in the standard template as shown here. The assessment is built for corporate, and CPPI tested that with their private equity portfolio companies and proves it practicable. So for more resourceful large listed companies, they should be capable of providing that. We tried it ourselves. We fit the major steel companies' transition plan into the assessment template. So here is the PAC profile of this listed steel maker. So we found that 50% of the steelmakers' decarbonization target can be achieved through efficiency improvement using proven technologies. So it is categorized as proven. 45% of decarbonization target counts on carbon capture and green hydrogen, and it is categorized as probable. This steelmaker mentioned in this sustainability report that green hydrogen costs, if it come down to 70 US cents per kilogram, the technology will become commercially viable. In the US, it is estimated that the Inflation Reduction Act will bring green hydrogen costs down to 50 cents to $1 US per kilogram by 2030. And US accounts for 15% of this steelmaker's output. So indeed, we should be able to put part of this probable decarbonization upgrade to proven. But its disclosure at the moment is limited, so I just can't, do that. It doesn't allow me to perform a full assessment at the moment. Although we cannot complete the full assessment, this exercise demonstrates that substantive value accretive abatement through efficiency improvement can be proven, not distant, and proper engagement can drive a change now. For instance, we can discuss whether or not we can push some of the decarbonization before 2030 with the company. It also provides the grounding for asset managers to engage with policymakers, for instance, for economic incentives to turn probable PAC into proven. And imagine if we can compare different steel makers in a standard template alike. So I can compare and see which steelmaker is more likely a decarbonization leader. And for corporates which need financing, we think it will be more persuasive if they can use credible and feasible transition plans for capital raising and communication with asset managers. It is honestly a bit complicated, particularly it is definitely not a tool that can help investment advisors selling transition finance product to retail investors. We can see many EVs in many parts of the world, but can you tell if it is made of green steel? If we wait until an EV made of green steel and clean battery in front of us, then selling the idea of a transition finance product or transition finance strategy to retail investors probably will be much easier. The thing is, if we don't finance it now, it probably will never be ready. Next thing is, even if this EV is now made of green steel and clean battery, we won't be aware of that unless it is labeled. In the UK, FCA proposed a labeling of different sustainable finance products, and improve a label here will help to give a proper identity to transition finance product or strategy. It will help to ease transition washing concern, help to make the communication of transition finance strategy consistent, loud and clear. I understand that I think Abu Dhabi Global Market just recently also introduced a new classification system for financial instruments, include climate transition and sustainability link. So that will also help to give a proper identity to transition finance product. Honestly, there is no consensus as we talk to our interviewees that whether labeling is the way to go. I would say indeed it is quite binary, their opinion, but we need something straightforward to communicate our message to retail investors and pensioners. While we don't think this label, let's say improver label, with it in place, retail investor will just fall in love with sustainable improver. But we think with this proper labeling that will give investors, retail investors, the clear option of low emission or lowering emissions. And ideally, if retail investors and pensioners really support lowering emission or this sustainable improver labeled product, then sustainable asset managers will be more willing to incorporate decarbonization of high emitting assets into their portfolio. And asset owners will also be more willing to allocate more capital to drive real world transition. So starting from end investors, hopefully they will help drive mindset change, which is the very difficult part upstream. To recall, one of the challenges to transition finance is that it can be risky. So investors worry about the technological risk, the stranded assets risk, and we mentioned that we need to add impact lens to our investment, and once it is added, then we're exposed to impact risk as well. So the unfavorable outcomes include both financial and non-financial. That include capital loss, that we may have no exit due to poor liquidity of the assets, and there will be like impact performance, what if it underperform? And then we may fall into transition washing traps as as fund managers managing the transition finance product. So to mitigate technological risk, blended finance is a proven structuring mechanism for downside protection. Normally, it is either for bespoke large-scale projects like infrastructure, or for supporting micro, small, medium enterprises in developing markets. And we have also incubator and accelerators funded by blended finance facilities in developed market. In recent years, we are seeing more such like blended finance incubators for developing market as well. Here I'm showing an example for development of decarbonization technologies for steel making in India in particular. There are also proven cases of climate bad bank and reverse auction, which provide exit to assets to be stranded. Impact of transition finance is often demonstrated by decarbonization. We have talked about like sustainability-linked bonds and loans, which help to secure impact performance. We have talked about how to peel the onion to review real-world decarbonization of a portfolio. We have talked about how economic feasibility in the transition plan can raise the confidence level of impact performance. Recently, more companies are tying executive pay with decarbonization target performance. They will give investors extra comfort that the management team is committed to deliver the decarbonization target in their transition plan. In EU, the Corporate Sustainability Due Diligence Directive, we call it, you will always see it as CSDDD, proposed to make such a tie to indeed mandatory for large companies with over 1,000 employees. One more thing I want to highlight here is that climate and transition finance is speaking about decarbonization, but taking a holistic approach to climate and environment, it is not the only impact asset managers should consider. That, for instance, in sustainability, this is sustainability-linked loans. Sorry, I have it should be SLB and SLL. Many of the sustainability linked loans will have multiple sustainability performance target. One example is Carrefour, a retailer in France. One of its 2019 sustainability linked loans is attached to 17 targets. So likewise, we foresee that for sustainability linked bonds, it will be attached to more than just emission target going forward. So while regulators worry about asset manager greenwashing, asset manager worrying about corporates greenwashing, because as mentioned, it will affect their impact, leading to underperformance, implying impact risk, and also reputational risk for them. We talk about how economic feasibility can make transition plan more convincing. We talk about tying executive pay with targets written in transition plan will give us more comfort. But still, as we mentioned earlier, we do not have a standard framework to define credible transition plan. And at the same time, after ISSB finalized the IFRS standard just back in June, SEC regulators in EU, in Hong Kong are all talking about transition plan disclosure. And for small and medium-sized enterprises, which already have difficulties complying to existing sustainability disclosure, they will be facing new challenges to comply to transition plan disclosure. Even if they are not listed, there is supply chain due diligence they have to deal with. So they may have to answer to different investors and different customers from different countries with different sustainability and transition plan disclosure requirements. We therefore hope to see a digital modular disclosure platform to help SMEs mapping different frameworks. Or like a combination, if you want to see live example, it is indeed a combination of the CDP SME climate disclosure and Singapore Stock Exchange GSE Genome platform. You can check those two platforms, they are live. You can see how they work. So here my suggestion is indeed a combination of those. And ultimately, if transition plan disclosure can be standardized and also mandatory, it will help to ease fund managers' concern of transition washing traps. Finally, what can governments do to accelerate the real world transition? Honestly, here we don't have any innovative ideas, and probably we don't really need any at this moment of time, as there are still a lot of elementary steps we need to go through. For instance, we think China and India can consider, accelerate the setup of their taxonomies and disclosure framework to define transition finance. In the US, probably they need to encourage material and energy efficiency as well, while they have the Inflation Reduction Act to help to lower the lower cost of hydrogen and carbon capture. And the EU needs to concentrate on implementation of its many policies, many laws, rules, and guidelines in place. That it should focus on improving the existing programs, striving for leaner processes, and focus on debureaucratization and effectiveness. So, I think why don't we take a 5-minute break now? Then we can come back for the conclusion and case studies and Q&A afterward. Welcome back. Hope you have some fresh up. We are now coming to conclusion, and then we will have a few case study live examples for you to think about. So finally, coming to this, our conclusion for the time being. We talked to our interviewees. A few ideas indeed inspired us that willingness go hand in hand with capability, and that climate change is the unequivocal fact, and looking for perfection is indeed the enemy of the good. We all have a common end goal, net zero. However, our mean goals are inconsistent. Sometimes it could be incorrect. It does not mean we need consensus of mean goals, as transition is very different in different countries, in different regions. We need different mean goals. In addition, for the entire world, it is our first time and probably the only chance for us to deal with net zero transition. Almost everything is work in progress, and we need careful planning to avoid wasteful trial and error. But at the same time, avoiding trial and error will lead us to neither failure nor success. We need progress. We need to dare to be wrong. Then, during the process, we can learn from error. We always talk about so my concluding remark here would be that we cannot just wait and see. That's my whole thing for the theme for this this project, that let's try, and whatever you can think of, please tell me. Let me consolidate, and then let us drive an acceleration of our net zero transition. Let's go through a few real life cases and see what do you think. Case 1, in Sweden, there is a vertically integrated cement plant that it produces 3/4 of the country's cement. And in 2021, the court in Sweden rejected the extension of the plant's limestone mining license due to concern over high levels of chloride pollution it caused to the underground water. The environmental problems of this single cement plant sent the whole construction industry of Sweden into a panic. We are talking about 400,000 job losses, 11% of GDP in jeopardy, blah, blah, blah. Later, the license was extended again and again. At the same time, the plant announced a plan to become the world's first carbon neutral cement plant. I do not have more information, so this is all the public information that I put together into this case. So based on this limited information, what can investors or lenders do considering public information, public news, if they are interested in this carbon neutral cement project? I don't have an absolute answer for that. I give you some time to think about. I don't know what, if you have new idea, again, please send me those ideas. But what I'm thinking of is, I bring up this case indeed is to demonstrate the overlapping of sustainable climate impact and transition finance, as we always talk about a holistic approach to environment. Transition finance sometimes concerns managed phase-out of high-emitting assets and therefore human and organizational factors from time to time. And in this case, I believe one option we can consider, also as we mentioned earlier, is multiple sustainability performance targets, if it is that instruments we are talking about. So out of these KPI or targets, what will you choose? So again, my disclaimer is I don't have an absolute answer for that, but I can't go to this link at the moment. But if you take a look into the IFRS exposure draft, which now become the standard, you can see under mining industry, there are 3 metrics and targets we need to consider. One being emission, yes. The second, probably you can think of for this case, is water, yes. And the third is indeed energy efficiency. So if possible, I am allowed to pick. So these 3 will be, I would say, my primary choice of TPI or targets. Probably, if I have more information, that probably we have to consider more. Let's go to the second case, which is also a real life example. A power company in Greece issued a sustainability bond in 2021. One of the sustainability performance targets, SPT, we call, is a 40% reduction of Scope 1 emissions in 2022 from 2019 baseline. If it fails, it will have to pay the 50 basis point step-up coupon as a penalty from 2023 through to 2026. It is a case for illustration only against the backdrop of energy crisis over the past 2 years. We probably have to be more understanding. But of course, one of the questions for you to reflect can be what the investment committee in this case should consider. But today, what I want to show you is the penalty of 50 basis point is only 0.4% of the recurring EBITDA of this power company. And if the company were required to settle the difference through EU ETS, the value sum indeed will be 80 million euro. But now the cumulative penalty from 2023 to 2026 is 15.5 million euro only. So it's a fraction of this 80 million. So indeed, more often, the step-up coupon of sustainability-linked bond is like a standard 25 basis point. It is debatable, however, whether the most frequently used 25 basis point or even here like a 50 basis point step-up penalty fee is well substantiated, as it neither reflects the financial materiality to the issuers and just has an unequal effect as an incentive. It also does not reflect the environmental materiality, and just a small, let's say a small polluter missing emission target by 1% is no difference to a big polluter missing target by 10%. This is just one option or one idea I'm throwing out. If you have any idea of how to make the mechanism better reflect the materiality, please share with us. Case 3. It is our last case for today. The World Bank issued an emission-linked bond to finance a water purification project in Vietnam. The project is expected to reduce emission by 3 million tons, and the emission reduction will become verified carbon unit, VCU. The coupon payment are linked to the number of VCU issued, but not directly to the VCU. They're not paying you coupon as if you were an investor, they're not paying you VCU, but the coupon payment will be linked to the number of VCU issued from the project. So investors don't have to worry about the price volatility and more importantly, the marketability of VCU. The bond is bulletproof. It is synthetic and structured. And it is indeed an outcome-based instrument, which supposedly start with a clearly defined outcome, in this case, like decarbonization, then works towards a solution that helps deliver on this objective as closely as possible. So here, do you think the use of emission-linked bond to support more projects, for instance, sustainable agriculture in developing markets, do you think it works? Do you think we can have a plain vanilla emission-linked bond instead of like this highly synthetic and structured emission-linked bond, meaning using VCU directly as coupon payment, then it will become more applicable to more projects? So again, I repeatedly have to remind everybody here that I don't have an absolute answer for that. But if we can scale up the emission-linked bond market to finance, as I mentioned, more sustainable agriculture projects in developing market, there will be more supply, number one, of quality carbon credits, which we can also foresee at the same time strong demand of quality carbon offsets towards 2050 from, for instance, the offsetting of an economic abatement of high-emitting countries. Just to recall much earlier, we talked about that steel, listed steel company. It has 5% of an economic abatement that they need carbon offsets to help them to achieve net zero. So we can imagine that on one hand, with this emission-linked bond, we will have quality supply to satisfy the demand towards 2050 from these high-emitting companies, which we are quite sure they will need that if they will have to achieve their net zero. However, between now and 2050, the marketability of this VCU coupon will be questionable. So let's come back to it again, that emission-linked bond can help accelerate decarbonization in developing market, we're sure, and it can also help accelerate the development of voluntary carbon market as a quality supplier. And at the same time, the emission-linked bond need an active carbon market to accelerate the development of this emission-linked bond. So you can see the relation of like chicken or egg. So now we have quality supply, let's say we have emission bond, and we can see future demand. So how are we going to link between this quality supply and demand, but only in the future? What we need to do, the missing piece, one of the missing piece of the puzzle will be how to drive demand between now and 2050. So referring to our case 2, what if this power company will have to buy also carbon offsets on top of their normal step-up coupon? So in this case, you can see they have 0.93 million ton of deviation, and that indeed coming to this project 3 million ton. So if they were to buy offset, then indeed it can absorb like 30% of this VCU to be issued. So indeed, back in 2020, Etihad Airways in the Middle East, it includes also a penalty in the form of carbon offsets for its sustainability-linked sukuk. So again, as I repeatedly said, your comment and feedback is very welcome. This is not the only option, and probably you can have more idea about how to activate a voluntary carbon market for more outcome-based instrument to come for our carbon offsetting of high-emitting industries towards 2050. So if you have other ideas about the more solutions, and also in case you have ideas about other challenges you can think of for the development of transition finance market, please anytime give us a shout. So that's all from me for today. I think we can go to the Q&A session if you have any questions.
That's wonderful. That's great. Thank you for your time. I have a couple of questions. If we could go through them. We have a question that you mentioned attribution analysis. What exactly is it? Sweeney?
Okay, this is 2 live examples. So on the left-hand side, this is from a FTSE Russell report. So what they did is they decomposed the changes in WECI of the FTSE All World Index from 2017 to 2020. So if you can see the step-by-step, indeed, the reduction of weighting in WECI, you can see from here to here. So there's a reduction of WECI. But indeed, the key contributor to this change is this weighting change. So what happened is they lower the weighting of carbon-intensive industries in the index. So therefore, the change. So this is one thing, one example of why attribution analysis can help you to decompose the portfolio decarbonization. And second, this is by Norges Bank Investment Management and Asset Owners Sustainability Report. So what they did is they do the attribution analysis. And what we can see here is why the major contributor to this WECI reduction is selection effect. So in their sustainability report, they explain that one thing is they indeed allocating more capital to low emission sectors like healthcare and financials. This is for this particular year. So this is how attribution analysis can help us to understand, to decompose portfolio decarbonization and explain what happened there. So just to remind us indeed whether this attribution analysis is following what the fund managers' objectives and strategy and methodology in their fund document.
Perfect, perfect. Okay, you mentioned that there's no consensus on labeling so far. So for those against the labeling, what are the reasons behind it?
Let me see. Hopefully I should. Okay, just let's stay here. So firstly, I talked to investment professionals from different parts of the world. And their company also is like based in our headquarters in different countries, so they have to follow the head office policy. So firstly, indeed, there is quite strong regional bias. Very much depends on where your company or you are located at. For instance, in Europe, we have a lot of rules and regulations here. We are very used to that. So indeed, they go for, they support labeling. They just, okay, why not? Let's have more clear definition. Let's have more rules and regulations. We are very used to that. They want everything well defined. For instance, in Asia, their interviewees think transition is a process. So things keep changing, as we mentioned, everything is work in progress. So any standard, any labeling scheme which trying to fix something at a particular moment of time will have to keep changing as well. So they are doubtful if a labeling scheme itself can follow closely with the change. In the US, probably the regulators only concern, but the major concern is about greenwashing. So they don't have a lot of regulations. So indeed, for US investors, US-based broker house, probably they are more, they will be, they prefer things to be more flexible. So those are, I would say, for different reasons. Some of them, they're against labeling, and it very much depends on the history indeed of how regulations are developed in their region. So here we can also see how regulators, how the government indeed can shape the investment industry. So that's my answer to like, why are they against that?
Perfect. As you talked about, talk to different investment professionals in the different countries, do you see any consensus or very fragmented views?
So just like we mentioned, labeling, that's quite binary. Taxonomy is also there, very binary. Again, going back, it very much depends on where you're based in, indeed, most of the time. But there are, I would say, some consensus view will be stewardship or engagement, that in different part of the world, different countries, different or different fund managers with different background, I think they all will be more coming to a consensus is about engagement and stewardship. Probably they have different policies as depend on the parent company or their holding company, depending on the mandate of specific fund. But I think that's in general, they have to invest, they will spend resources, they will develop their questions, and then that's what we are all doing, I think, in different parts of the world. So some of them may have different focus. For instance, in Europe, they may expand to outside of just emissions. They care about water, they care about like social impact of their fund. So they may have a more long list of engagement due diligence list. But in the US, probably they have different. They don't adopt exclusion in general, but they will have their own engagement policy, which apply to all portfolio company, whether it's under ESG fund or not. So they will have they are also complying to the same stewardship or engagement policy. So I would say if there's any consensus, it will be about engagement, but still they will have different view, but at least they are all committing to that.
That's great. That's great. I have all my questions answered. That's great. I would like to thank you for attending this webinar, and I hope we have you again, inshallah, in the future for the Financial Academy webinar. Everybody who's interested to have this any sessions of the Financial Academy or webinars in the from the Financial Academies that would like to have any to attend any webinar and any program that belongs to the financial sector, you could visit our website and see all those webinars and training sessions that belongs to the same subject or a different subject that belongs to the financial field. Wish you all the best. Wish that you have a wonderful journey with Ms. Weenie, and
Thank you very much.
I hope that we have you again. I wish that we reach your expectations. And if you don't mind, we would like to take a few seconds to scan the code and give us your feedback about the session. Thank you again, and wish you all the best. Thank you so much, Ms. Winnie.
Thank you.
Thank you.